Hi, welcome to Chartered Training Center. Today we are looking at IFRS 10, Consolidated Financial Statements. Alright, just a side note. Okay, don't laugh at my beautiful illustration here. Okay, it's just to lighten up the air. Alright, so what is this standard about? Okay, this standard is about how companies who have subsidiaries under them should present their financial statements. Okay, so if you are a company and you have subsidiaries under you, this standard prescribes how you should report or how you should prepare your financial statement. All right. So we before anything else, let's start to define some terms under the standard. Okay, so let's look at the term parents. We have subsidiary and we also have control. All right. So let's look at this illustration here. We have a man and his children. Okay, this man controls these children. When we say controls, it means this man decides for these children what the school they should attend, the food to eat, where they stay, the clothes to wear, and a number of decisions. Alright, this man takes decisions on behalf of these children. Alright, so when we say a parent, when we talk of parents in accounting, okay, we are referring to a company that controls other companies. Okay, just like this man controlling his children or deciding for his children. Okay, so we have companies that also controls other companies. Okay, all right. So the parent is the company that controls the other companies, and the subsidiaries or the subsidiary is a company that is controlled by the parent. Okay, so in our illustration here, we can say that these children are the subsidiaries. Okay, and control. When we say control, we are referring to the ability to make decisions, significant or major decisions over someone. Okay, so that's what we mean by control. So, in a nutshell, a parent is a company that has the ability to make decisions or significant decisions for the subsidiary. Okay, and the standard says that once you are a parent and you have a number of companies under you, you are required to present consolidated financial statements, even though there are some exceptions. Alright, there are some exceptions to this principle. Okay, now let's look at one of the top group of companies in Ghana. Okay, Jospon group of companies. Okay, this is one of the biggest group of companies in Ghana, and they have a number of subsidiaries. Okay, and some of them are Zoom Lion, Alliance Waste, Appointed Time, Cosmopolitan Health Insurance. So all these companies below here are called subsidiaries. Okay, these are subsidiaries, and this is a parent company or the group. All right. So this head or this parent company controls the affairs of all these subsidiaries or all these companies under it. All right. Let's continue. Okay, so first of all, when we say to consolidate, what does it mean? To consolidate is an English word. Okay, it means to add two or more things together. Okay, so to add two or more things. Okay, that's all that it means to consolidate. So if you have, let's say, um, you have a list of names, a list of names here. Maybe you have the names here, and in a separate sheet, you have another list of names in another sheet. Okay, so to consolidate means to put these two sheets together as one. Alright, so that's what it means to consolidate. Okay, so when we say consolidated financial statements, we mean that we are adding all the financial statements of all the subsidiaries and the group together to form one single report. Okay, so when we take just one group of companies, okay, each subsidiary prepares its own financial statements. Okay, each subsidiary prepares its own financial statement. But and the parent also prepares its own financial statement. Now, when we are consolidating, we will gather all the financial statements from the subsidiaries, add all of them together, okay, including the parent, and then we'll put them together as a single report. Okay, so for instance, let's say that in a particular month, Zoom Lion sales or revenue, so let's say this is revenue, was 1,000. Alliance Waste revenue was also 1,000. Then Metropolitan Health was also 1,000. And then Appointed Time was also 1,000. Okay, so to consolidate means we are to add all these revenues together, making 4,000. Alright, so this is a consolidated amount. Alright, and then we have to add the group revenue as well. Maybe if the group revenue is 5,000, you add it, so making 9,000. Okay, so to consolidate means to add up two or more things together. Alright, now when does a company when do we say a company controls another company? Okay, when do we say a company controls another company? Now, a company controls another company when these three conditions are met. Okay, one, that company has power over the subsidiary. Okay, the investee is also known as subsidiary. Okay, that company has power over it. So we'll look at what it means to have power over a subsidiary. And that company has the right to receive variable returns from the subsidiary. So for instance, that company, let's say the company has made an investment in the subsidiary. So the company expects some returns from the subsidiary. Okay, and the parent has the right to receive those returns. And also the parent company or that company has the ability to use its power to affect the amount of the investors return. Okay, we discussed here that that company has right to receive returns, let's say dividends from the subsidiary. So not only do they have right to receive the dividends, but they also have the power to influence how much dividends they are entitled to. They have the power to influence the dividend that they are entitled to. So when a company satisfies these requirements, then we can say that that company has control over the other company, and therefore that company is a parent. Okay, and the other company is a subsidiary, right? A subsidiary. Okay, so when we say a company has power over a subsidiary, what does it mean? Okay, so when we say a company has power, it means that the company has the right to make decisions on behalf of the company, or right to direct the activities. Okay, direct the activities, right to direct the activities of the subsidiary. Okay, so the company can decide what the subsidiary should do. Maybe the parent company can decide that, oh, they should embark on intensive marketing. They should explore other products. They should increase their market share. They should employ some more people. They should increase their sales force. Okay, so that parent company has power to, or has the right to direct the activities of the subsidiary. So which means that company has power, or the parent company has power. Okay. And also that company, or the parent company, also has the right to appoint or remove key management personnel. Okay. They also have the right to, or power to remove, okay, remove or bring on board some key management personnel, okay, which indicates that that company has power over the subsidiary. And let's look at the other one, which is right to variable returns. Okay, so this is by virtue of the parent's investment in the subsidiary. Okay, so the parent the parent has made investments, has invested money in the subsidiary. Okay, and so the parent expects some returns. Okay, the parent has the right to receive returns from the subsidiary because of the investment. Let's say the parent has invested 100,000, $1 million. Okay, so the parent expects returns from the subsidiary. Okay, and has the right. Not only do they expect returns from the subsidiary, but they also have the right. All right. So now let's look at the other one, the ability to use their power to influence the amount of their return. Okay, so the parent also has power to influence the performance of the subsidiary, such that their return from the subsidiary can increase. All right, so let's say the subsidiary is not doing well. Probably they are facing some financial issues or difficulties. The parents can step in and restructure the subsidiary, maybe pump some more funds, do some more investment in the company, revamp the subsidiary, decide that the subsidiary will be able to come back and and do well in the business. Okay, and when the subsidiary do well, in the business, the parent will get good returns or good dividends, okay, from the subsidiary. All right. So the parent also has the right to influence the performance of the subsidiary through decision making certain critical decisions or strategic decisions for the subsidiary. All right. Now, one may ask, so how does a company achieve control? How do you get control in a subsidiary? Okay, how do you get control over a subsidiary? Okay, there are a number of ways of gaining control over a subsidiary. So one of them is having majority shareholding. Okay, so let's say you have more than 50% interest in a subsidiary. Okay, it gives you the ability to control the subsidiary. Another way is contractual arrangements. Okay, so the parent can enter into a contract with a subsidiary, and the contract will spell out certain terms and conditions. Okay, so through the contract, the parents can have control over the subsidiary. Another way of gaining control is through potential potential voting rights. Okay, potential voting rights. So these are not actual voting rights, but they are potential. It means there's a there's a there's a likelihood of the company or the parent company getting majority shareholding in the subsidiary. Okay, so for instance, if the parent company holds share options, okay, holds warrants, or holds convertible debt instruments, convertible debt instruments. Okay, these instruments has the potential to increase the shareholding of the parent. Okay, and therefore increasing the likelihood of the parents to become uh, to gain control over the subsidiary. All right, so these are some of the ways that a company can gain control over another company and therefore becoming a parent. All right, so we'll end here and we'll continue next time. All right, thanks for watching and see you next time. Bye.